Let's talk about this movement that we're seeing here at the opening, because we are seeing a bit of a rebound in the tech space now that move higher across all three of the major averages, coming on the heels of the latest data that we're getting on inflation. The Fed's favorite inflation gauge, PCE, coming in line with expectations. That core year-over-year number slightly higher than what the street had been forecasting. Let's talk about that and more. We want to bring in Adam Hetts. He is Janus Henderson Investors global head of multi-asset. Adam, it's great to have you. So talk to me about how you're looking at the massive sell-off that we had this week, a lot of that being led by the rotation out of those larger cap names, and maybe what that signals about the volatility ahead.
Hey, good morning. Thanks for having me. And yes, happy Friday. After a pretty dramatic week, we sort of went from Goldilocks economy back to growth scare. And now it seems today we're wrapping up the week back in, I think, Goldilocks mode. And so we had PMIs, we had GDP, we have PCE today. So it's enough economic acronyms to make any normal person's eyes glaze over, I think. But the bottom line here is that we've got the economy chugging along. I think we had a bit of a reacceleration earlier in the year, and now we're in this mode of slowly slowing, which is where this Goldilocks optimism is coming from. So I think all systems go, green lights from the economy as far as the news this week. It's still encouraging. When we're talking to our clients, though, and we're thinking about the market returns that have accompanied this economic optimism, there is a big disconnect between what the economy is telling us and what the market seems to be expecting and pricing in. And that's a source of risk for us as we're thinking about the next 6 months in market returns.
Yeah, that dichotomy, there always seems to be a split between the Main Street and the Wall Street economies. What are you expecting from the Fed next week? The consensus is nothing happens in July at this meeting that we get next week, but it's setting up for a September rate cut, and there's a lot of speculation about that. Do the numbers from this morning kind of feed into that? What else would you want to see personally to see that September cut?
The numbers feed into it, it helps. And look, rates and inflation are some of the hardest to predict parts of the market, and a market that's overall impossible to predict to begin with. I think in the comments that we'll look for next week from the Fed, the market's at least expecting a 90% chance of a cut in September. And there was a little bit of a push and some discussion around July cuts, but it seems like the mix of data seems to be consistent with that September cut. I think you want to see NFP, non-farm payrolls, come in next week, again, with that slowly slowing pace, not too hot, not too cold. But again, it goes back to this is a market that is essentially, for better or worse, pricing in these Goldilocks outcomes. So it's a very sensitive market. It's a nervous market, and it's a very expensive market. So if we see any blips in the commentary, we see any blips in non-farm payrolls or the next CPI print, that's going to lead into the September meeting. And then you can probably expect some pretty violent market reactions. And we saw that this week. We're seeing 1-2% swings easily within a day when this Goldilocks narrative gets disrupted.
So then, what does that essentially then tell us about this rotation that we have seen out of tech? Is there more downside ahead for what had been the leaders within this most recent leg higher? And if so, what do you think the degree of that downside could potentially look like?
Well, the degree of the downside comes from this historic level of concentration we've all been living in and frankly embracing for the last few years. And that concentration within the U.S., it's the U.S. tech sector making up over 30% of the U.S., the Magnificent Seven piece of the sector at least. So there's that. And then it's just U.S. making up a historically large part of the rest of the developed world. So there's a lot of eggs in one basket when it comes to the market right now. Then you look at overall headline valuations, sourcing from that concentration of those really high multiple names. Now you've got overall multiples on the S&P 500 running at levels that are above 20. I mean, once you get above 20, think about long-term historical multiples closer to 17. In other words, you can easily see a 10 to 15% derating if this narrative gets disrupted. But this gets back to the point of the economic background feels solid and stable, and we're not seeing those fractures or cracks in the surface of the economic foundation yet. So when we look at that 10 to 15% derating we could potentially witness in the S&P broad line, then you could also see potentially, if tech earnings don't go as hoped, you could also see some earnings expectations come down as well, which could compound on that 10 or 15 drop, and that could very easily spell out a bear market technically at 20%. So I'm not saying that that's our base case, but we're staying really close to our clients right now. We're focusing on the economic optimism, and we're focusing on the fact that the market is relatively expensive, and you probably could expect a correction to that between now and the end of the year. But going back to your question, luckily that spells a lot of opportunity for the market broadening and for investors that have wanted to diversify away from those concentrated expensive names for so long, but paid a price for it.
Yeah, I know.
Now you're getting some value for that.
Yeah, I know you like small and mid caps, so that's where I want to get you out of, and Europe as well. So last question is, where do we put this money here?
Yeah, so what you've seen over the last month is you're almost getting this double-digit dispersion from the small and mid-cap space compared to the large-cap names. And so that's what we like to continue to see. We love the broadening. The catch there is we're going down in cap, going to the other 493 in the US. 40% of the small cap universe is unprofitable. And these are also the more cyclical, value-oriented names. And the same goes for Europe. So as we're diversifying out of these bigger growth-oriented names, we have to remember those are more resilient in that rare case of a hard landing type outcome. So as we are diversifying, going down in cap, going ex-US, we're looking for growth. We're looking for quality as a bit of a mitigator as we add more cyclicality to a portfolio in what's still a late cycle environment.
All right, appreciate your thoughts here. Thank you, Adam Hetts, Janus Henderson Investors Global Head of Multi-Asset.